Welcome back, everyone, to the Exchange Live. My name is Paul Hill. I'm delighted again to be able to speak to accomplished investor Roland Head of Stockopedia. So welcome, Roland.
Oh, thank you, Paul. It's good to be back with you again.
Yeah, well, we need some help, actually, because there's been a ton of news over the past week, not least the attempted assassination of Donald Trump last weekend, the release of Labour Party's growth strategy in the King's speech midweek, and also obviously the outage the IT outage this morning that stopped all the RNS feeds. But before we sort of get your view on what this all means for the markets for the rest of the year, I don't suppose you could just quickly remind the audience of what kind of stocks you like, what type of businesses you go for.
Yeah, absolutely. So I suppose my main focus is on what I'd probably call quality income shares. So companies with above average quality metrics, good profitability, cash conversion, but also reasonable valuations and a good track record of reliable dividends, preferably over long periods. And so that's kind of the majority of my investments. And then alongside this, a smaller part of my portfolio is also invested in what you'd probably call growth at a reasonable price. So, affordable things that appear to have good momentum, a near-term growth case. And those tend to be stocks that I trade a bit more often, probably. And that's actually the portfolio I write about at Stockopedia for any subscribers there.
What, the income side or the GARP side?
The GARP side is the stock. It's a mirror really of the SIF portfolio, which is a model portfolio I've run at Stockopedia for about 8 years now.
Yeah, and how's the portfolio overall, your own personal one, performing so far this year? I mean, mine's had a bath, but in fact, I'm a bit of an exponent of GARP, but my GARP stock picking is terrible. So how's yours been getting on?
Yeah, well, I think this year my GARP stock picking has been better than my income stocks. I mean, some of my income stocks have done well, but there's been a couple of problems, and overall, that side of the portfolio hasn't done as well as the GARP side, which has done okay and been a bit ahead of the market.
And what about,
so mixed, really?
Yeah, and what about sort of your outlook for the rest of the year and for the next sort of 12 months on the markets? Because we've had a real sort of had a ballooning US market, particularly all things driven by AI. UK has not done badly, actually, at the top level, certainly in the FTSE 100. AIM's sort of come back a bit, but still a long way away from its highs. Interest rates are projected to fall eventually. We've got 2 cuts in the UK. Inflation has now declined back to sort of the CPI, the target level of 2%. In the UK, and actually overall consumer balance sheets across the world are not bad. It's the government balance sheets which are in problems. So putting all that together, how do you see sort of like equities and the economy performing?
Well, I think with the interest rate, interest rates, it looks like it's one of those things that might be nudged back a little bit, but my sort of base case is that it will happen at some point, probably, but slower than maybe people are expecting. In terms of equities, I think some things are not quite as cheap as they were, but broadly speaking, I think there's still some good opportunities, and overall, it's a reasonably positive market, I think, on a medium-term view. I try not to make too many predictions about the economy or anything related to it, because it's not something I really understand, and I don't have a good track record of anything like that. So I tend to just look at the focus on the fundamentals and valuation, balance sheets, especially with a higher funding cost. The attractions of net cash and low levels of debt are really becoming much more obvious. I think you've got companies that are actually really making money from holding cash, which is something they've not been able to do for a long time, and not having to refinance at higher costs, which is also a positive. So I think, I'm broadly positive about UK equities. I suppose you have to be to some extent to be an active investor, but I do think there are still some good opportunities. Yeah.
Yeah, I think you're too modest in terms of deciding what the economy is doing. But yeah, I'm with you. I think it's probably more a buffalo market rather than a bull. It's a bit heavier, a bit slower, but it's moving in the right direction. That's sort of how I would do it. But I think top of the market, actually, in the AI, there is actually it's nosebleed levels, and there's lots of potentially capital destruction. In terms of one thing which has been dragging the small cap sector, particularly sort of like GARP over the past sort of 2 years, has been fund manager redemptions. I don't know what your view is on that one. I did see probably the key exponent of that, one of the fund managers, Premier Miton, saying that actually had seen an inflow into its equity funds in June. Only 1 month, but you've got to sort of like clutch straws when they're around.
Yeah, I think, well, Premier Miton and also Polar Capital's a bit more of a positive update, really. They've had net inflows overall in the second quarter. And so, although I think a lot of their exposure is to technology and healthcare and so on, isn't it? So it's maybe more of a global picture. But I get the feeling that the outflows are coming to an end, but it's kind of hard to be sure. Impacts and Ashmore have both reported another quarter of outflows, haven't they? And they're kind of specialist fund managers with a good track record, I would say. But yeah, I mean, I think the tide is turning, but I don't have a lot of insight really into the kind of what drives institutional flows. I think in some ways what's interesting is that retail investors in the UK anyway still seem to be putting cash into investment platforms. But if you look at the updates this week from the investment platforms like AJ Bell, we've had, well, all three, AJ Bell, IntegraFin and Hargreaves Lansdown, I understand, although I haven't seen today's RNS, but I understand they've all three of them have reported net inflows again during the last quarter. So they're attracting money, and presumably some of it's going into investments, whether that's US tech stocks or treasuries, or some of it hopefully also into the UK market. So people seem willing to invest, but I'm not entirely sure where they're investing and whether fund managers maybe need to do a better job of really articulating what they offer and why it's worth paying for, because there are a lot of other simpler options, especially for DIY investors as well.
Yeah, no, I think a lot of the money has actually gone into US equities and also fixed income funds, money market funds, and it's still staying there really because a lot of people are sort of a bit hesitant about sort of like investing potentially at the top of the market, and they just clip 5% off the interest rate, But how long will that will stay?
I mean, when you can get 5% without any real risk, you can see the temptation after what people may have experienced previously.
Yeah, no, I mean, my portfolio, I've got about sort of 13-14% in just in gilts at 5%. So I'm one of those, and I never invest in fixed income other than obviously at the moment because it's an opportunity that I haven't seen for 20 years. Now, if anybody wants to ask Roland any questions, please put them into the chat bot and I'll read them out. We've got one already, but we'll cover that in a moment. Let's go to a really topical company that reported this week, Burberry, which is the luxury sort of trench coat manufacturer, brand. It's seen a really softening off of its luxury retail sales. I think they're down about sort of 15-20% across the board. They've got rid of the CEO here, and I guess it sort of like springs to, from an investor perspective, what the American Indians used to say: if you're on a dead horse, the best strategy is to dismount. But you have the opposite view. So you to tell us what's sort of the attraction of Burberry.
Yeah, well, there's I mean, I've held Burberry for a number of years, and originally I bought, I saw it as attractive for kind of the usual reasons really for luxury brands. So, traditionally spending on luxury is relatively resilient and tends to bounce back a bit quicker after recessions. I think, overall, I saw it as a kind of valuable heritage brand. It's nearly 200 years old, and I think it probably still is a valuable brand. And financially, the track record has always been good. Operating margins have been kind of 15 to 20% typically, and a return on equity is high. The balance sheet has been strong in the past, becoming slightly less strong now, I suppose, and the dividend hadn't really been cut for 20 years except during the pandemic. So I always thought it looked like a good long-term business, given its track record, but obviously things have come off the rails a little bit at the moment, and demand has really down globally, and especially I think China. And so the question is it just a downturn, or has something fundamentally changed? And my approach, rightly or wrongly, is not to react too quickly, I suppose, to these things. And I'm inclined at the moment to wait and see what the new chief executive says and does, and what happens next. I think the new bosses come from Michael Kors and Coach previously in recent jobs, and so there may be more, maybe Burberry's strategy of trying to elevate its offering and become high, move up the luxury pyramid hasn't worked, and it's been doing it during a difficult time. But whether the opportunity for the company is to focus a little bit more on the mid market and make itself slightly more accessible again, I don't know.
Yeah.
But yeah, I mean, I have to admit, I averaged down on this in May at £10, and I thought that would be a cheap price. So I've misjudged the situation at the moment. But I'm still hopeful. I still believe there's value there. Nearly 2.5 billion in sales every year. It wouldn't take a lot of recovery in margin for the current valuation to be attractive, I think.
I think you've hit the nail exactly on the head there, Roland. I mean, I've unfortunately been in lots of these type of stocks, which look artificially cheap and then get sort of cheaper. But it really comes down to your view. Have Burberry got a defensible moat? Have they got a kudos with the brand? And as you say, is it a temporary or is it in secular decline? And I guess the other side of that coin is what is going to turn this ship in terms of getting that kudos back to get it actually to be sold, to get luxury, because the price points in terms of its outerwear are quite high, but that doesn't mean it doesn't chime with sort of the affluent consumers.
Yeah, I think it's a fair point. And maybe one thing with Burberry too is that its outerwear has always been a core part of the brand, but I suppose raincoats are not kind of sought after and desirable in the way that, say, handbags might be to luxury buyers. So the product range has always been a little bit, I don't know what the word is, quirky maybe. And to turn it around, I suppose they've got to stabilize volumes and maybe look at costs and look at the store network. A lot of money's been invested in that recently, but I think it's really pitching the product at the right level. So not too high, but not aiming too high, and obviously not aiming, not devaluing the brand, but not aiming at a customer who's looking somewhere else. You've got to it's got to be pitched right, and that doesn't seem to be happening. But I think it's probably worth saying that they're not the only luxury brand having problems at the moment, and so there is obviously a wider slowdown. And I think for me, it's worth waiting to see if that passes as it has done in the past, I suppose.
Yeah, and there's also a remote chance that they might get taken out because LVMH has always been sort of like thought of a potential buyer, and there could be another luxury brand that wants to pick it up at a very, very cheap price. As you say, it only trades at roughly around about 1.4 times sales, and also sort of like it looks artificially expensive on a PE basis, but that's really that's a trough level margin. So yeah, there's always potential upside. Now, got a couple of questions. We've got, or should we say, comments. We've got Peter T saying buffaloes apparently are slower than bulls, so aren't slower than bulls. They can both run at about 35 mile an hour. Phil Curtis says, morning chaps, and then Steve Lewis says, have you got any thoughts, Roland, on Duke Capital, which I think is Duke Royalty, but I don't know if you've had a look at that. I think it's a royalties on minerals or something like that.
Yeah, I think they used to be Duke Royalty, and I think they've called themselves Duke Capital now, partly because from what I understand, they, as well as lending money at I think historically they lend money at quite high rates, but they've also started to take more equity stakes in some other companies where they're invested. So I think I haven't followed this in detail, but from what I understand, they're increasingly moving towards a kind of hybrid model of debt and equity investments in their investee companies. Always had a very high dividend yield, but one thing that is worth, that some of that has been offset by the fact that they have also issued equity regularly to raise new funds, and nothing. I'm not suggesting, it's nothing underhand, and it's not because they've been in distress. That's been the model they've used, paying out very generous dividends, but also, raising equity when needed. So I think the share count has almost doubled since 2020, for example. Whether that will slow down in the future, I think that's the plan, that they will rely less on it. So one of those things, a very high yield and often looks superficially cheap, but it's quite, I think the businesses it lends to, there's quite a mixture of companies, and it's one of those things where I think you need to look through and get an idea of the quality of the underlying investments. It's not something I've done that much detailed research into beyond that understanding of it, really, but
Yeah.
could be potentially interesting for someone who gets into the business and understands it.
Yeah, I think Simon Thompson of Investors Chronicle likes it, actually. So, and as you say, for an income investor, it has a lot of attractions. Got another question from Paul L. He says, "Morning, gents. Any thoughts on Serica Energy, which is extremely cheap, to say the least? I think it's about sort of like, I was just looking at the numbers. I think it trades at less than 4 times PE."
Yeah, the dividend yield. I think the dividend yield is expected to be about 16%. I mean, it's obviously been really hit by.
It's just for everybody. It's a North Sea oil and gas producer, isn't it?
That's right. Yeah, it's actually one of these independents that's been bought up a number of legacy assets or mature fields from various other operators, and it's become one of the larger independent producers in the North Sea now. And it's, as it has been recently, terrifically cash generative and starting to pay some quite nice dividends. The shares have really sold off, I think, on fears that, well, partly this year because of fears that Labour are going to increase the taxation rate on the energy profit levy that was introduced by the last government. Labour have said they're going to increase that slightly, I think, by another 3% and extend it just another year or so to the end of the current parliament. And I think there's also been some discussion that they're going to scale back some of the investment allowances that companies can currently, claim back against on capital expenditure. So it's very, very cheap, and the question is the cash flow sustainable, or is it all going to be eaten up by tax? And will new investments be viable or profitable when the rules change, or if the rules change? So the chairman, I think, has been quite vocal, saying that if the government changes the rules again, and investment might become unviable. But my feeling is that it probably is cheap, even with the potential impact from higher taxes. I think the cash flow, forecasts at the moment seem to suggest the free cash flow will be roughly twice the dividend over the next year or two, from what I've seen. So that suggests there is a bit of wiggle room in there. And although the marginal rate, so under Labour's policy, the marginal rate on profits is expected to be 78% for these North Sea producers, but that's the same marginal rate Norwegian operators have had for many, many years, for decades, I think. In fairness, the difference is they also benefit from quite generous capital allowances in Norway. But I think what the real problem here is the lack of stability and visibility that these companies have had for successive governments over the last 20 years or so have tweaked the tax regime in the North Sea. And if you look on the Norwegian side, it's the same ocean but a different regime, and there's been much greater stability there. And my suspicion is that if we get some of that stability for the UK North Sea, these companies will remain kind of profitable and reasonably cash generative. I think Serica at the moment is in a position to keep on producing quite stably for a few years without needing massive new projects, and so I think they're just. I think it probably is an opportunity. It's something I've really looked at personally and been quite tempted by.
Yeah, I mean, I would say sort of top level, the government needs to look at how much revenue it's going to get in. And I think they're going to get a lot more revenue by encouraging development in the North Sea and then taxing at a reasonable level, because to get the most out of the UK oil and gas assets, particularly in security of energy supplies. So that's a really fine line they need to actually, sort of like tread. And if you look at it just on the maths to see how so much, it's been sold off, 6 years of dividends, and you'll get all the purchase price for the shares back. I mean, it's absolutely an income monster, isn't it? So
Yeah, I mean, and Labour have said that they're going to plan. They don't want to license new fields, but they're going to want to get the maximum out of what's there. They're planning to, to get the most out of what is already developed in the North Sea. So I think there's an opportunity probably, and I think also that Serica, getting new licenses and new operators, it's probably going to be harder for them to enter the market. Serica is well established in the North Sea, and I think it's well positioned possibly to benefit from further consolidation and eventual decommissioning, or however the North Sea evolves. So yeah, I think it's probably an opportunity, and as I say, it's something I've been looking at a lot.
Yeah, no, I'll have a good look at that. Okay, let's switch sectors to the consumer. We've got flooring and coverings business. James Halstead, I think he's private, it's sort of family owned still. I'm not sure about that. But anyway, Carpet Writers actually looks as though it's gone in bust. That should reduce competition. But it is obviously a topical issue because people for discretionary spend in their houses have been holding off, and that's really been a sort of feature across the world, not just in the UK. And I guess you quite like the sort of the view of the sort of an economic rebound happening in, I don't know, Europe and Asia and the UK. What sort of attracted you to James Halstead?
Yeah, so you're right. It is a family firm. It's still really under the control of the family, and the chief executive, Mark Halstead, is obviously a family member, and he's been in charge since 2002. So it's been in business for over 100 years, and the flooring side of things dates, I think, from the 1940s when they developed vinyl flooring under the Polyfloor brand, and that's still the core product, and that kind of displaced linoleum back in the day. And I think it mostly serves commercial markets, so it's quite a high quality product, and that's the kind of positioning. So you find it in hospitals, schools, shopping centers, office blocks, and places like hotels and cruise ships and so on. So it's quite a high end brand. I don't think it's necessarily have such exposure to the residential market in the UK. But what I like, it's quite a high quality business, really, in my opinion. It's a long history of strong profitability, a really strong balance sheet. I think net cash was about 60 million or so at the end of the half year. So that's actually generating additional profits for them now just from the interest. And it's one of those companies that's been through a lot of cycles. It has a very stable model, a very good history of delivery, nice kind of a decent market share and brand positioning. And I think it's likely to continue doing what it's done successfully for a long time. Growth is probably maybe a bit of an issue, both in a macro view and also looking at the company itself, where it can expand and where it can still gain share. But I think, I think it's possibly quite attractively valued. It's one of those stocks, one of those AIM stocks that rarely looks cheap, but it has come down a lot, and the yield's over 4% now. Yeah. And I think it's just a nice, good quality business, the kind of thing that can be tucked away for a few years without causing too many sleepless nights.
That's the tempting fate, that one.
Yeah.
The PE looks at about 19 going forward. Is that just trough earnings? They're still making.
Well, the profits have come down a bit. There was, like a lot of these companies, there was a real boom during the pandemic, and then the supply chain crisis. They carried very high levels of stock, and they were still able to meet orders, but there's been a bit of a reset because obviously input costs rose and so on. So profits are down a little bit, but they seem to be stabilizing again now. I wouldn't say these were trough earnings. They're below the peak, but they're somewhere between. They're at a level that's been seen in the past. I think really what it is partly that almost all of the earnings are returned as dividends each year. When you look at dividend cover, it's only about 1.2 because they've got all this net cash anyway, that there's no need to retain a lot of earnings. So that's one reason for the high PE. And I think also when you look at the quality metrics, return on equity is generally about 25%. Margins are kind of 18 to 20%. So I think it's a good quality business. It can justify some kind of premium. And right now it isn't really. Earnings have pulled back a bit over the last couple of years, so that may that may account for it as well. Like a lot of these things, maybe the risk is in the timing of a recovery and as much as anything else, but I'm happy to be patient with this one, I think.
Yeah, and also if its competitors or other people in the industry go bust like Carpetright, then it must put it into in a better position, you'd have thought.
Yeah, I mean, I think James Halstead sells more into the trade and to direct commercial customers. The Carpetright has had maybe different problems, especially with its competitors, I think.
Yeah. Okay, we've got a good question coming in from Peter T asking about Renold. He says apparently yesterday Paul Scott on Stockopedia was having a go at the company, talking about excessive director share issues or something. But I don't know whether you've had a look at Renold. It's actually it's a chain manufacturer for industrial applications, for conveyor belts and for luggage handling in airports and stuff. And it's had a bit of a heavy pension scheme and a bit of debt, but I think the debt is now started to get paid off, and I think the pension deficit is also recovering because of the higher the corporate bond yields. The shares have done reasonably. I don't know if you've got any quick thoughts on this one at all, have you, Roland?
It's not something I've looked at in a lot of detail, partly because it doesn't pay dividends or hasn't done until its forecast, I think, just to maybe start. But it hasn't really paid any meaningful dividends, probably because of some of the problems. But you mentioned, I think, I think it's a good business, a kind of not a heritage business, but a long established business with a good reputation in its market. But yeah, I don't think I've got too much to add. I haven't looked at the results in any detail, but I did see Paul had covered it yesterday.
Yeah, and look, I mean, look at the chart. The momentum is definitely upwards. Not that I'm a chartist or either of us are on chart, particularly good on charts, but it would say that I think it's still relatively cheap if you believe the numbers, and it generates sort of cash. So yeah, I mean, my view would be that it isn't something, if I was holding it, I would immediately selling. That's for sure.
No, I don't think so. And I think the interest rate issue and pensions, a lot of companies are being released from some of the pressure they've been under with pensions, aren't they?
Yeah.
It's quite a step change, I think, for a lot of businesses.
Yeah, no, you're exactly right. Okay, let's switch sectors. Another one, but cyclical. We've got Michael Page, or the Page Group, which is probably I think it is the biggest UK recruiter, alongside Hayes. It came out with sort of softening expectations, a bit of a trading update. Again, something that wouldn't immediately spring to mind as a sort of Roland Head perfect sort of stock, but I guess you say you're looking at the economic forecast with a glasses half full sort of lens.
Yeah, I've been looking at this really on a cyclical view. I think it's, as you say, it's one of the biggest, possibly the biggest listed one in the UK, with a very long track record of growth through the cycle. And again, not a chartist, but when you do look at the chart for the last 20 or 30 years, you see successive peaks and troughs and then a kind of gentle trend upwards. And well, I would never predict that
until recently.
You need to zoom out a bit to see the trend. Yeah, it's I have to admit, I think it's a good business, and it has a long track record of really quite long-term management. It hasn't had that many people in charge, and it's had a consistent business model and performed well for a long time. But I was a bit surprised by the warning. I think it was last week, wasn't it? The company's saying basically the number of new jobs being registered is looking soft, and confidence with clients and candidates is quite low. So sometimes, even when an offer's made, candidates are apparently being reluctant to commit to a move. So it doesn't seem to be pointing to an immediate upturn in terms of the economic outlook, but I suppose I generally look at cycles as when you're at one point in the cycle, it looks like it's never going to change, and then it does, and then you find yourself further along, and it's very easy to think, I suppose, the way things are is the way they're going to be. But I tend to try and I think the way I invest in cyclical stocks is to try and see through that and believe that the patterns that have happened before will probably follow again in a similar way, although it's always difficult to time these things. But I'd say Page Group is another one I like, because I think even after a year or two of weaker performance, it's still got plenty of net cash. I think 56 million net cash it reported recently. So I think the ordinary dividend is probably still safe. It's well established, good reputation. Globally, it's got plenty of international exposure as well as the UK. And it doesn't seem to be suffering any worse than the wider market. I think Hayes and Robert Walters have both said quite similar things about a slowdown over the last couple of weeks as well. So it's another one for me that, superficially now it doesn't look very cheap. The forward PE is, I think, 31 for this year and then falling to about 18 next year. And the dividend doesn't look like it's very well supported. But I think I'm hopeful that will gradually come out in the wash, as it were, as the cycle evolves. But it's another,
yeah. Yeah, I mean, it's got another 3.9% dividend yield, so you get paid to wait, don't you? While so the upturn potentially happens. Okay, got one question coming in from Phil Curtis asking about the property franchise, which I think just bought Belvoir, didn't it? Not recently.
Yeah,
basically an estate agent. So again, another one, I suppose, which is a cyclical sector. Housing as being hasn't done too well of late, but I think investors have sort of bid up this business ahead of a recovery in housing transactions and lettings, which I think about 50% of its business.
Yeah, I think as you say, lettings has really helped to offset the weaker, the fall in housing transactions for a lot of these estate agency groups has been offset by a rise in lettings income, I think, and the shares have continued to do pretty well since the merger. I haven't looked at it in much depth since the merger. I've been kind of waiting for the first full set of accounts of the combined company to come out. I don't think that's happened yet, just so that, to get more of, I like to, when something like that happens, they're both similar sized businesses. Yeah. So I think it's interesting to see what the combination looks like when the dust has started to settle a bit. But in principle, I've always had a favourable impression of it. In recent years, it seems to perform well and have been well managed, generates plenty of cash, and the shares, I don't know what would be, the shares are looking a bit more expensive than they were. So I probably, from a personal point of view, I'd probably look for a better time to enter. But with it being the property market and the potential for recovery, anything could happen, and it does look quite a strong business, I think.
Yeah, and also with the Labour government saying if it gets anywhere near its targets, it's going to be building more houses, then you're going to see, more houses coming onto the actual market, also being let as, buy to let and build to rent and all this sort of stuff. So, the whole activity curve should increase and benefit these guys. And as they get consolidation across this sector, then the big get bigger. So I'm with you. And I think the online risk that has always been hanging over the market has been proven with purple bricks that it actually doesn't work, because people want a service wrap which is proper and honest and will actually do the job when they're selling and buying their own houses. So I'm with you. It looks a good play. Okay, let's move to a payments company, PayPoint, that I know you quite like. Still very cheap, even though the shares have done well. It's sort of like got a number of different streams. It's got the ATM machines and the payment terminals in lots of sort of convenience stores. It's also got an online delivery business as well. We have pick up and drop off points at sort of like these stores as well. And I think also it has is it Love to Shop website, which does sort of like gift cards and Christmas hampers and stuff like that. What's your latest on this one? Because still, I think it trades at less than 10 times PE.
Yeah, it's one of those things that's looked cheap for as long as I can remember, and I think one of the problems, or one of the problems maybe with this business, is that it's quite complex. There's a lot of different revenue streams in there. There's some of them are more legacy, relating to the old cash payments business where people used to pay their bills, like utility bills, with cash at PayPoint terminals, and then there's newer things that have come through acquisitions, card handling businesses. That's been expanded recently with a partnership with Lloyd's that allows PayPoint now to offer, I think it will offer really a one-stop kind of payment and business banking solution, or card payment and business banking solution for merchants in its core, in its core kind of small business market. So, and also the you mentioned Love to Shop. That was acquired, I think, with Appreciate, which used to be listed a separate listed business, but PayPoint bought them with that. So, and that's a Christmas savings scheme and the Love to Shop vouchers business. And so that's probably still being integrated, I think. And what's interesting about the business is, for me, really, is its footprint in convenience stores. I think it has about 30,000 customer sites across the UK. So it really has a wide reach, and management seem to be quite good at finding new ways of generating kind of incremental revenue from things like different sorts of vouchers, card payments, benefits, all sorts of things come and go. The difficulty is sometimes understanding, I think, where the margin really is, as opposed to just generating the revenue. But you can't. I think the performance so far has been encouraging, and does seem to be, the business does seem to be delivering some genuine growth. Margins last year, operating margin was about 18% last year, and there's a 30% return on equity. It's always been very cash generative. The dividend yield is still nearly 6%, and I've been skeptical about it for a while because of the complexity of all the changes in the M&A, but I'm coming around to thinking that it is working and it does seem to be delivering positive results. So I think it's as you say, still looks cheap and could potentially deliver. I think, if the growth can be proven over a few years, then I think it's worth more than the current valuation. I suppose I would look at this as roughly a zero growth kind of value, more or less. But,
I mean, I think there's definitely growth in its online delivery business, but obviously that's quite competitive in terms of the likes of Amazon and the other sort of like guys, etc., DHL and these kind of people. But it comes down, I suppose, to the sort of the structural question with the ATM or that machine they put into the actual shops, because the ATMs outside, the bank ones, have been stripped out. People aren't using physical cash as much on the payments. And I know these ATMs which they put in, their PayPoints are different because they allow you to receive and to pay and all this sort of stuff. But I guess that's the sort of the structural question. Is there something which is, as technology comes in and people start doing more commerce, mobile and online and stuff, is this a growth division or not?
Yeah, I think that's a fair point. It's how much the business is still really dependent on its legacy activities and how much of the profit is being generated by activities with real growth potential. And that's always, I think that's the hardest thing to understand. But the impression I get is that some of the newer initiatives and some of the current, what you could call current products, like its point of sale terminals and its card payment assets and business, are generating a meaningful contribution and are delivering some kind of growth, or have the potential to deliver growth. So I think it's it's one to watch and to try and understand a little bit more about, really.
Yeah, I mean, with a 6% dividend yield, and it wouldn't be surprised if one of the private equity guys have a shot at it because of all the cash it generates, and it's sort of its strategic positioning in these corner shops. There might well be something that they can do on a roll-up basis that is difficult to invest in the public markets, and therefore, if you take it off, then you can do it in the private market. So interesting. Just a reminder for everybody, if they want to ask Roland any questions, please drop them into the chat bot and I'll read them out. Now let's move to another sort of like stock that was a darling years and years ago, RWS, which is a sort of like translation business for sort of websites, but more for sort of like the technical side, healthcare, specialized applications, regulatory applications, and patents, which is obviously very difficult to copy by the sort of the AI side of it. But the shares have really been sold off. Anyway, it came up with a trading update just recently, said it's seeing a better second half than first half. It's been through a bit of a tough period, and I think 25% of its turnover now is AI generated, because it has been a leader in this game. What's your sort of your latest on this one? Because I was just looking at the numbers, and it trades at, say, again, just over 8 times PE, plays a 7% dividend yield, has been doing a stock buyback program, which I think has now stopped. But anyway, sort of what's your view on this one? That is sort of the translation business.
Yeah, so I think it's from what I understand, it's the second largest translation service provider in the market globally. So it is long established business, and it does have decent scale and market share. And as you say, the service is split across kind of unregulated large-scale translation for consumer groups and stuff like that. And then the more niche stuff that's higher value, like regulated services and so on. But it's suffered from, I think it's suffering from a couple of problems at the same time. Externally, customer demand is said to have been down in some areas due to various factors, cyclical factors, or regulatory changes that have created a uneven pattern of work and various things like that. But there's also the whole question of generative AI, and I think RWS says it's been using AI type technologies for a long time, or machine translation for a long time. But the question that I think that's probably still being understood, or not yet fully understood, is how the newer generative AI tools like ChatGPT that are built around these large language models, and how they, whether the risk is that there'll be a long-term kind of destruction in demand for some of the lower end translation work. RWS, like its competitors, they're investing a lot in IT, and they're trying to develop, I think, solutions that encompass the best of the new technology, but also the value of the previous types of machine translation that they have quite a lot of expertise in. And for me, the investment case, and I do own the shares, the investment case is that I think there'll be a role for what you could call enterprise grade quality services, even if they're using similar technology behind them to free services like ChatGPT. There'll be a role for companies will want to ensure that they know about the quality of the data that's in the large language models behind the translations, that the quality of the output is going to be guaranteed, and also that the solution may be part of a larger content management solution or suite of products, which is something RWS has expanded into. So for me, and then I think the niche regulated services like patents and financial services and healthcare, they'll continue to need expertise beyond an automated system, or at least that's kind of my base case. That's why I think for RWS, it probably is cheap and does have decent recovery potential at the moment, especially if external drivers of demand pick up as well. The risk is obviously that, like we've seen, like you see sometimes periodically through history, new technology can be much more disruptive than anyone really expects at first, and there's obviously a risk that could happen here. But I think there'll still be a role for companies such as RWS, or for a few large players in the market, and I think RWS, has the potential to be one of those. So my best case scenario is it could become a really like a high recurring revenue software type business that generates nice reliable cash flows. But time will tell. But I think it looks cheap at the moment, and the buyback, as interestingly, was below book value, so hopefully that wasn't wasted money, even though the share price has stayed weak.
Yeah. Now, what'll be interesting for me is, I actually think, it's on the balance of probability, it probably is a trophy asset still in the sort of like the language translation arena. Now, if one of either Amazon AWS, Google Cloud, or even Oracle's cloud decides to adopt their proprietary sort of and private large language models for translation into their platform and sell that as their services, then it will be a huge potential, booster and value driver for the business, i.e. they white label what they've got to one of these big guys. The danger is that Microsoft, who own Nuance, who are equally very good sort of like technical translation business, particularly in sort of healthcare, that they offer it as part of their Azure cloud services, and they offer it for free on top of it. So it's a sort of like to me, it's a sort of bit of a binary play. If they can actually grab hold of one of these huge hyperscalers and hyperscalers offer it to their enterprise customers, then I think this could triple, quadruple in share price. But equally, if everybody develops their own internal applications for companies, then I think they're going to struggle. But anyway, we will find out presumably whether this is a trophy asset in the fullness of time.
No, I think you're right. I mean, one interesting factor about this is that it's still controlled. Andrew Brody, the former chairman,
Yes.
he's just stepped down. He still controls nearly 25% of the shares.
Mm,
So whether he'll be looking for some kind of exit at some point is
yeah.
maybe there might be some takeover potential here. The quickest way to acquire this technology might be to buy it, I suppose.
Yeah.
But yeah, no, there's definitely some risks that the as you say, companies will just be able to do it themselves
Yeah.
cheaper, or that someone else will get the best
Yeah.
opportunity.
Okay, we've got another question from Peter T. He asks, the share prices of house builders have all moved up, but what about the brick companies? You got any preferences between Forterra, Ipstock, Michelmersh, and Brickability at all, or ever had a look at them?
I've looked at Michelmersh quite a bit in the past. I've always really liked that. I think it's a nice business and with good quality brands and products and a good track record. So again, it's not as cheap as it was, but it still looks quite reasonable to me. Ipstock and Forterra, I think they're kind of larger, more mass market offerings. I'm not as familiar with them, but I think they'll both be okay when demand recovers. But Michelmersh is the one I like as a more of a quality play, and with a longer track record too than the other two.
Yeah, I own Michelmersh, and I prefer it's my selected one out of the four. And the reason is because it sort of concentrates on the premium brick, the aesthetically pleasing brick, and it's actually still relatively cheap. I think it trades at about 10 or 11 times PE, pays a decent dividend, got really sound balance sheet, positive net cash, and it is what it does. It doesn't compete in the volume side of it. So it doesn't do the sort of your breeze blocks and all this sort of stuff. It does the sort of the clay bricks, which really just have only real competition with London Brick, which I think is owned by Forterra, and the imports. And clearly, with transport costs going up, then the imports are struggling, and therefore the Michelmersh still has good pricing power. And yes, I think the housing market overall will take time, but if as I say, if the Labour government comes in and we start seeing new ground being broken, which is happening already, then the foundations need to get put in first. Then the brick manufacturers benefit. So I would say it isn't going to move particularly strongly in the next couple of months, but certainly by it comes to the year-end trading update, I think all the brick guys are actually going to start seeing better outlooks in terms of distributors asking for higher volumes into 2025. So I think this is a trophy asset actually, and I've held it for a very, very long time. So that'd be my preferred play. Okay, good. Let's move sectors. We've got RS Group, which I think is a distributor of sort of like specialist industrial parts from a whole bunch of different suppliers, and I think its niche it sells is that a lot of the builders or the makers of these very specialist industrial parts need sort of local distribution, but particularly service, and so do their end customers, and the end customers take it in small amounts in broken shops. So what's sort of your view on this one? Obviously, the global economy has been tough, and so it's been GDP it's been weak on the like for likes, and also probably had some destocking. But what sort of attracts you to RS Group?
Yeah, certainly it's been a tough couple of years. Like you say, there was that same big boom in demand into the pandemic, and then during when the supply chain became difficult, you had customers who wanted to build up stock, and RS also probably built up stock. And so the last year or so has been pretty painful. The shares have really derated, and the company itself has been, destocking, dealing with the soft customer orders as customers have destocked and demand has returned to more normal levels. And RS itself has also been reducing its inventory. So it's been a bit of a painful time, and the shares are really back where they were at the start of the pandemic, basically. But as you say, it's a business that's all about scale and distribution reach, and it is able to acquire and consolidate smaller competitors periodically, and I think it's done that quite well generally. And it has a vast range of stock that it can provide good availability onto customers all over the world. So it's one of these distribution businesses I quite like. Sometimes they are quite profitable and they generate quite a lot of cash partly because they have the scale, and they also have the buying power that a lot of their inventory is funded on generous customer payment terms. So they're not having to, fund the cost of they can provide good availability without having to pay the full cost of it themselves, essentially, because their suppliers we give them the credit. And so the end result is that although it's not a particularly high margin business, returns on capital have regularly been over 20% in the past, not last year, but many previous years. As I say, cash generation is good. The dividend history is quite good, although it was cut after the financial crisis, but hasn't been since then. And I think it's a nice business that logically can continue to evolve and to consolidate and to consolidate the sector, because customers benefit from the scale it can provide, and it can provide, and the economies of scale that come in as well help it to be more profitable than the smaller companies. In some ways, I suppose it's a little, not quite like Bunzl, but a similar principles in some ways of being able to consolidate the market and benefit from that.
How important is sort of management in these types of businesses? Because I did notice the new CEO. Well, I think he's appointed about sort of 12 months ago, Simon Price. He used to be the CEO of BBA Aviation, which he improved and then sold, and then he moved on to Ultra Electronics, which again I think he sold. Well, he did sell, a few years back, and so he's moved on to this one. What's sort of your view on with RS Group in terms of? Is it going to be the same strategy, sort of like take the business on when it's going through tough times, improve it, sharpen it, improve costs, and then it's all open the bid?
Well, you can't say for sure, can you? He certainly is talking about costs and efficiencies, and and I'm sure he's hoping that margins will recover when demand normalizes a bit. And I think the latest commentary from them suggests that they're starting to see like-for-like sales are leveling out. They're still slightly negative, but really leveling out now. And I think there's a reasonable to expect revenues expected to return to growth this year, and their operating leverage with the business means profits could recover quite well, I think. So whether he thinks that whether this is another takeover candidate for the future, I don't really know. But yeah, as you say, he does seem to have a record of building businesses up and selling them. So I don't know. I'm not necessarily a fan of M&A constantly. It's nice when you get that hit from the sudden profit in your portfolio. But if you're owning, especially with companies I want to own for a long time, if you believe in the potential for the income and the compound growth, then exchanging that for a one-off capital gain now is sometimes it's a bit of a mixed blessing, isn't it? I think, because you have to find something to replace it, don't you? And it's not.
You're a tough man to please there, Roland.
I don't really
over any day of the week, mate.
Yeah, I don't mind. I never complain really, but there are some of the offers we've seen come through recently, I don't think they've been always massively generous, but a little bit opportunistic, some of them, especially with small caps. And so it's probably less of a problem with larger companies like this.
Yeah, okay. All right, we've got a question coming in from RP Invest. He says, do you have any opinion on Assura, which I think is a UK REIT that invests, has been, in sort of primary care, healthcare facilities, so things like doctor surgeries and stuff. And the shares, I guess, because of interest rates have gone up, have fallen quite heavily. I don't know if you had any look at this as an income play at all, Roland.
I'm not familiar with this one in particular. I know, as you say, there's a lot of REITs at discounts at the moment, and I think some of them do look attractive, but this is not one I've looked at, I'm afraid.
Yeah. Okay, well, let's move on from that one then. BATS. We've got Phil Curtis saying expected to have little growth, but throwing off lots of free cash. What's your latest thoughts on BAT, the cigarette maker?
Yeah, I mean, I can't really argue with that. There's all the investment case, I think, is quite well understood. There's the risk that at some point demand will slow down quicker than it is doing already. But on the other hand, it's a global business. It's really got the scale benefits, and it does throw off a lot of cash. Debt levels are still quite high, although they have started to fall a bit. But yeah, it's kind of what it is, really. It's I think that for the foreseeable future, the tobacco stocks probably remain a good bet for income.
Okay, good. We've got one quick question coming from Peter T again, asking about the building product supply industry. And he says, any views, any favourites at all? We've got Almasac, Eurocell, Epwin, Northern Bear. I know you like Somero, don't you? Which isn't classic sort of like residential property. It does the screening machines for the online warehouses.
Yeah,
yeah. I don't know if you any thoughts on that whole sort of like construction product, sort of building products industry.
Yeah,
Not
I think
really.
I mean some of them. I looked at Eurocell a while ago and actually was quite impressed, and I didn't do anything about it. But I did do. Yeah, I did look at them a while ago. I think some of the window companies we've seen in the past, they're not always. Sometimes I wonder how differentiated some of them are, but
Yeah.
But yeah, I mean, I think you have to look at the opportunities do come out in this sector. It's not something, they're very cyclical and they do sometimes seem to come and go. But I think there are. Epwin also seemed, I think, from memory, looked okay the last time I looked. And if their balance sheets are okay at this point in the cycle, then I think that's a good sign too that they're positioned, potentially positioned to benefit when a recovery comes. And as we're talking about with housing demand, it could. Windows, I suppose, and that kind of supply are a bit later down the development cycle, but they could potentially be in the pipeline. So I think it's there probably are some opportunities. But
yeah, I'm with you. I actually interviewed Gervais Williams on Monday, and I was talking about the building sector with him, and he thinks it's going to be a very good sort of strong recovery sector for 2025. Obviously, the whole area has been hit by the wet weather in spring and summer, which has depressed activity in the field, and you've also had the disruption caused by the early general election. But as you rightly say, it's just a time lag. So you get your foundations in from the builders starting to break ground. You then put your bricks in, and then the building materials will finish off the houses. So yeah, I think as long as you've got a strong enough balance sheet to get you through the next 6 months, then I actually think the order books are starting to really accelerate next year, and you'll get that operating leverage. So yeah, I think it's a great point there, Peter T. I think it's a good area to have a look around for cyclical plays that have been still sort of battered. You have seen a significant increase in Almasac, and Eurocell's done pretty well there. But I would point, look at Lord's Group trading. That one is still it's still very flat and down. So there's plenty of opportunity there. But it's obviously there's pick a mix which ones you think are best positioned. Okay, let's turn to Somero, because I know you like it, the online screening warehouse machine maker. It's out in America largely. Still knocks the ball out the park with numbers. It's 6% dividend yield, 10.5 times PE.
Yeah, I mean, you look at it and you think, well, it's obviously cyclical, and if construction slows down, then people won't be buying as many of their concrete leveling machines. But what they've reported consistently, really, over the last couple of years, is that non-residential construction in the US has been very strong, and the problem has been supply chain problems that have held back demand, with things like concrete availability and truck drivers and stuff like that on the ground. I like it because I think they are one of the market leaders. They stick to their niche market, and rather than trying to expand into areas where they may not have an advantage, they return a lot of cash to shareholders, and the profitability of the business means, as you say, it has paid out a lot in dividends over the last cycle, and I think now the balance sheet, they learned their lessons in the financial crisis, and since then they've really strengthened the balance sheet. And I think now they have a minimum of $25 million in net cash, which is their kind of baseline, and above that most of it tends to get returned to the shareholders. So I think it's a nice business. There's been a bit of a change of management, I think, recently, and obviously there is also always the risk that demand will slow at some point. It happens, I suppose, from time to time. But yeah, I think it's a nice business, and at the moment, the valuation doesn't seem unreasonable to me.
The value, the profit margins are terrific, aren't they? 26% EBIT margins. I mean, I guess the question is that sustainable?
Yeah, I mean, people often ask them. I think when you listen to the web calls, webinar calls, people often ask about pressures from competitors and that sort of thing. But it's one of those things. You're not on the ground in the industry. You don't have any direct experience of the product or competing products. But the impression I get is that they have a strong following. They have a very strong focus on service. They deliver the whole piece themselves to customers, training, service, support, and sales, rather than working through a lot of distributors and third parties. And I think that high value commercial products where the job is under time pressure and where the contractor's working under time pressure and a lot of other constraints, maybe Somero's offering is good enough to justify decent margins.
Yeah, well, they must have some pricing power to maintain those margins, no doubt about it. I suppose, but broadly, when you talked about the sort of the supply chain disruptions, do you see any risk at all to the markets if Trump sort of wins, assuming that if Biden, I mean, Biden will probably stand aside, but let's just assume, that Trump does win in November and he starts implementing these 70-80% tariffs on Chinese sort of products, but also lifting tariffs elsewhere, importing into the US. You're going to get retaliatory sort of tariffs probably across the world. Any risk to supply chains, again, disruption for causing that one, because it doesn't seem to have been priced into the markets at all.
No, I mean, it's one of those things. I think I can see what you mean. There could be a knock-on effect with things coming and going from the US, but I don't know. I think it's kind of beyond my pay grade, probably trying to work out the impact of that. A lot of it seems to be within the US, the problems Somero has talked about, but whether they'd experience new problems that were driven by external factors if Trump did become more protectionist, as he seems to be suggesting he might do if he was elected.
I think my take on it is I think investors need to be aware that if the price to import from China is doubled into the US, then the Chinese manufacturers are going to pointing that product and that capacity somewhere else, and they're already got excess capacity. So I think the danger is that they then dump the product elsewhere in the world. So if you're a sort of like a local manufacturer of areas that they have particularly surplus capacity, whether it's in EVs, whether it's in solar, I don't know, petrochemicals, cars, electronics, PCs, all this sort of stuff, then I think you need to be aware that actually you could get some really heavy competition coming in. And also, I think the other side of the coin is that, you've got big stocks, even in the Mag 7, like Apple, who I think still manufactures about 80-90% of all their iPhones in China, of which a large portion of that go into the US still, even though I think they have a new facility in India. And that could cause real disruption in terms of if the iPhone, I mean, people will still probably buy an iPhone, for $2,000 or $3,000, but even so, it might well sort of cause a lot of problems, I guess.
Yeah, there is an unpredictability factor probably that it's worth thinking about.
No, never.
Of what like second order effects, I suppose you would call them, wouldn't you?
I know, yeah. Okay, let's turn to sort of we got the infrastructure. We got Renewables Infrastructure Group, which I think basically invests in sort of clean energy facilities across the UK and Europe into sort of solar solar farms and also wind farms offshore and onshore as well. What's your latest on this one? I'm guessing, basically, again, the interest rates have come up, has been hit, and I think pricing of sort of energy levels has decreased from the heights of Ukraine. But what's attracted you to this one?
Yeah, so you're right. It's one of the older listed energy investment trusts on the UK market. So it floated in about 2013. And as you say, it's primarily wind. I think it's about 3/4 of the portfolio, then solar, and they're gradually moving into battery power. And I think it's total return over the 10 years from the IPO was about 7%. So it's not been a bad return. And during that time, the generation capacity has increased roughly tenfold, I think. So to getting on towards 3 gigawatts. So, it's been sustainable and it's been growing. And over that period, and it still has a decent pipeline of upgrades to existing sites and new projects. And as you say, the problem is the higher interest rates have pushed down the share price of Trig and lots of others like it, and they're trading below book value at the moment. So they're constrained in terms of raising money because they can't really issue equity at the moment. So that's put things under a little bit of pressure. But the way I think it's been quite conservatively managed generally. The leverage doesn't seem to be a problem. Most of it is amortized within the subsidy period of the specific project it relates to. And the company says the cash flow is still allowing them to do incremental investments and to maintain the dividend. And as far as I can see, that's that's been true so far. And even with the impact of lower power prices, which, as you say, have really come down to more normal levels. So I think it's I see it as quite a good example of the breed, if you like. I've followed it on and off for quite a while. And at the moment, the yield is about 7.5%, and there's that discount to book value. So I think if interest rates come down a little bit gradually at some point, that will be that could be a tailwind as well. And for a lot of the income is inflation linked, so that's another nice kind of hedge really against what might happen. So yeah, I think it's just quite a nice income investment and quite well run, as these things for what it is. So
sleep well at night type stock. The NAV I think is 125 and the shares are about £1. So significant
nice
discount. Yeah, one thing on the King's Speech, they did talk about, the Labour Party did talk about introducing a GB Energy sort of like group that would effectively invest in clean energy in the UK. Could that end to be a source of finance that renewable energy uses, or is it going to be a competitor?
Well, I think from what I've understood so far, I don't think it's not going to be coming in with kind of hundreds of billions to throw around. I think it's more, it could possibly be an investor in I think the idea, I think from what I understand, it could possibly be an investor in some of these projects, and perhaps having that involvement might be positive, since it could lead, it could give projects access to more competitive financing and so on. So I don't think it's a threat to these privately owned entities. I think it's more like hopefully be complementary and kind of supportive for new projects, really, as a minority investor, and maybe a good kind of not underwriting the funding exactly, but it's the involvement of GB Energy could help to add to the credit worthiness of a project, perhaps. So I think it's a bit early to say how these plans are going to pan out, but I don't think there's any sign that they want to derail the progress of projects, which is already really being held back by planning and grid constraints as it is, isn't it?
Yeah, I think you're right, actually. I was just trying to, the GB Energy, if I was them, I'd use it as effectively as a funding mechanism to help, say, 10% of a project's cost, and to sort of like, you guarantee that using the government's balance sheet to get these projects viable. So it then allows effectively these as cheap sorts of finance for a lot of these sort of clean energy projects, which means that it's people like renewable infrastructure have to put in less capital, but get the same sort of return off the back of it, because the GB Energy just get effectively a dividend, an interest rate clip. So I think it's a booster, actually. I'd agree. Okay, last one. We've got fund manager, the City of London Investment Group, which I think is basically it's sort of like a modus operandi is to invest in sort of like investment trusts, which is sort of like a discount. What sort of you attracted to this one? The shares have started to clip up, like a lot of them, I think.
Yeah, so as you say, they do have this specialist investment trust value strategies, really. And then a few years ago now, they merged with a US fixed income specialist called Carpus, and that kind of enlarged the overall business. And the problem with this business has been not attracting enough new clients and enough new inflows. But on the other hand, it's a long track record, a good balance sheet, and it's been very profitable. And so, I think it's at the levels it's reached recently. It's been offering good value, and if the I think there's been some pressure from the largest shareholder for the board and the company to become a bit more dynamic in terms of marketing and maximizing profitability of the offering. So I think it's attractively valued, and with a modest return, modest level of growth, I think it could become quite an attractive proposition again. The risk is that it's some kind of, some of the main themes where they invest. One of the main themes for them has been emerging markets, and that's been a difficulty, I think. Yeah. There's been a lot of outflows, and that's actually, I think, the only part of the business that still saw outflows during the first quarter of this year. I think the remainder of their segments saw inflows. So, and competing against the rise of the S&P 500 hasn't been an easy sell either, because a lot of their customer base is in the US. I think they've actually started reporting in dollars as well, so they've had a lot of headwinds, and you could arguably say that that's one of the reasons that things have been a bit slow. But it's I think it's one of those businesses that if they can engineer a little bit of growth and get some new clients, it could deliver a nice operating leverage and underwrite a really generous dividend as well.
Yeah, the dividend's nearly 9%, so it's very. What is their sort of their alpha? What's the sort of their USP? Is it basically investing in sort of the best investment trusts, sort of fund managers around the world with a real focus on emerging markets? Is that what you buy the shares?
I think it's more of a value strategy in terms of buying these things at discounts and benefiting when the discounts narrow and that sort of thing. Historically, I'm not so familiar with what the fixed income strategies they have are in the Carpus business, but yeah, I think historically it's all been about discounts and value plays with investment trusts, and that's maybe become a bit more difficult than it was, though, too, possibly because these discounts, especially with emerging market trust, the discount seems to have got wider and wider, and so the company talks about the value opportunities in its strategies, but it's not been easy to sell them, or they've not been very successful maybe at selling them, and when there's been maybe more obvious opportunities elsewhere.
Yeah. And just finally, have you been selling any stocks at all, or top slicing anything since we last spoke about 2 or 3 months ago, Roland? I know you're reticent to sell most things because you're sort of like a long-term holder.
I've not sold a huge amount. What have I sold? Not very much, actually. Not very much at all, to be honest. So no, the last thing I really did abandon, the last kind of what I hoped was a long-term holding that I abandoned was Close Brothers. Whether that would have been a situation that would have been better to remain patient, we'll see, I suppose, how the whole current situation plays out. But no, I haven't really sold anything from a long-term portfolio for a while.
Good. Okay. Well, I understand now from P to T that the RNSs are working, so that's great news.
That's some lunchtime reading there.
Yeah. Okay. Well, thanks again, Roland. Terrific insights as always, and thanks everyone for your questions. Great conversations there, and hope you all have a great sunny weekend. So thanks again, Roland.
Oh, thanks, Paul.